So we have a little bit of a quick note from Steve Howe, HOU, zero. He says, I've now been driven around by both Waymo and Tesla FSD version 13.1.4. I'm sorry, 13. What? I think he's got this wrong. 13 and 14, I guess he's saying. Waymo, he says, is very good. I felt perfectly safe while riding in it. But it's also quite obvious that it's driven by a robot with a little bit of ubiquitous jerkiness. I know some people like that. They're ubiquitously jerky. Anyway, Tesla FSD drives like a human, presumably because it's been trained on millions of hours of human driving. Beyond being safe, FSD makes decisive decisions to drive around blocking or temporarily stop vehicles, learns from previous mistakes of turning the wrong parallel lines, etc. It's just a much better experience as a passenger. And this kind of falls into line with what Brian Wang was saying the other day, is that in Austin, they're not having these issues with Teslas interfering and getting in the way and causing confusion, which we know is happening in Santa Monica, happening in Austin, etc. Okay, so what I want to do now is I've got 3 articles, 2 from Fortune magazine and 1 from TRUflation. And these 3 articles together really paint the picture, kind of how I see it. But I mean, sometimes it's not exactly, I wouldn't agree with the 100% of everything in here. But overall, I think this is a really, really good picture of where the economy is. And as you know, on this channel, what we believe is that in order to truly understand our investments, we need to understand the economy. We need to understand the macro. We have to understand the company itself. We need to the way the company's operating and therefore the fundamentals of the company. Then we need to understand how the company's stock works, why it's trading for, over 100 times earnings. And then finally, we do bring in the chartists. You got a couple of people on the program like Nicholas Gibbs and Brian Wang who they understand the charts. They're not chartists. They wouldn't call themselves that. They don't go into all the sophisticated, weird things that so many do. But I'll sometimes bring those folks into the picture too. Not personally, but I'll read the stuff that they have been saying. All right, but tonight we're going to talk about the economy. So Fortune magazine, in a previous statement to Fortune, Foundation CEO Michael A. Peterson described the $38 trillion debt figure and the speed at which it's accelerating as no way for a great nation like America to run its finances. Now, you may have been saying this for years. I've been saying it for years. It's sad what we've allowed to have happen with regard to the debt. The foundation's calculations underscored the acceleration of the debt issue. If it seems like we are adding debt faster than ever, that's because we are. We passed 37 trillion just 2 months ago, and the pace we're on is twice as fast as the rate of growth since 2000. For McGinnis, one of the greatest dangers is not simply the debt itself, but the growing sense of complacency surrounding it. The reality is that we're becoming distressingly numb to our own dysfunction, she said. We fail to pass budgets, we blow past deadlines, we ignore fiscal safeguards, and we haggle over fractions of the budget while leaving the largest drivers untouched. Well, Elon Musk has been saying this. I've been saying this. The Republicans have been saying, many of the Republicans have been saying this, but you can't get the Democrats on board. That's just my opinion. Proposals to tackle the debt, both Republican and Democratic administrations have added to borrowing. The Trump administration has shown an awareness of the issue and a readiness to address it. Indeed, Dalio has said Ray Dalio, has said that he's seen a greater realization coming from the current administration about the perils of America's fiscal environment, as I just said. According to the Congressional Budget Office, President Trump's one big beautiful bill will add $3.4 trillion to the national debt by 2034. That number was actually changed. I think Fortune magazine missed that. It says that number is the net of the decrease in spending of 1.1 trillion and a decrease in revenues of 4.5 trillion. The White House has repeatedly argued that the revenues expected to be generated by tariffs, estimated now by the CBO at 3.3 trillion over the next decade, will effectively balance the books. And that doesn't count any gain that we get from a business climate that's going to be so much better with fewer regulations, tax advantages, and all the work that Trump is doing with regard to onshoring. The CBO has calculated that President Trump's tariffs regime has the potential to reduce deficits by $4 trillion over the next decade. Some Wall Street analysts agree that tariffs are relevant on this subject. For instance, Apollo Global Management chief economist Thorsten Slok said in September that the $350 billion in tariff revenues being generated each year was very significant, while JP Morgan Asset Management's chief global strategist David Kelly wrote earlier this week that America was going broke slowly. The ratings agency S&P Global reaffirmed the U.S. credit rating, saying that the broad revenue buoyancy, including robust tariff income, will offset any fiscal slippage from tax cuts and spending increases. Still, the U.S. doesn't have a top credit rating at any of the three major rating agencies. Trump has suggested some unusual methods to rebalance the books. For example, he has touted a gold card plan, a visa policy which would charge each immigrant $5 million for a green card plus a route to citizenship. 1 million cards would be worth $5 trillion. And if you sell 10 million of the cards, that's a total of $50 trillion. Well, we have $35 trillion in debt, so that would be nice, Trump said. He noted that he would have $15 trillion left over if he managed to sell 10 million cards, adding it may be earmarked for deficit reduction, but it actually could be more money than that. While the math doesn't necessarily add up, as the majority of millionaires already live in the United States, and the volume of foreigners with a net worth of at least 5 million may be harder to drum up, it nevertheless suggests a willingness to begin addressing the issue and using unique approaches. By the way, though, in many cases, that $5 million wouldn't be paid by the individual who wants to come into the country. It would be paid by the corporation that wants to get that brainiac in their company. Indeed, while Trump's tariff plans have proved unpopular with foreign governments, yeah. Economists nonetheless welcome the peculiar methods to increase America's income. As Wharton professor Joao Gomes previously told Fortune, you can also not deny that Trump and his administration bring strange forms of revenue that do change the debt picture. Meanwhile, what about inflation? But Swank, chief economist at KPMG, sees something else, a slow-moving problem that's partially statistical, partly structural, and increasingly psychological. It's creep instead of surge, she said, noting that the headline number masks persistent stickiness in service sector prices and a widening split in who's actually feeling relief. We'll talk more about that in a minute, but in the service sector, I've said it over and over again, service sector is going to be harder to bring under control because it's based on labor, and labor prices hopefully will continue to be going up faster than inflation. Beneath the surface, why is that? We want the labor prices to go up faster than inflation so that the folks are getting real income increases. Beneath the surface, she argues, the U.S. is running on shaky footing, both economically and in terms of the quality of the data that guides policymakers. Man, we've been talking about that. Swank pointed out that many of the categories holding inflation steady are either insulated from tariffs or benefiting from temporary waivers: computers, smartphones, and some vehicle imports. Once those fade, goods prices are still moving up, she said, with a few signs of broad-based disinflation. Core services, less shelter, a metric the Fed watches closely. That's core services, less housing, shelter. A metric the Fed watches closely rose about 0.4% in September, Schwank estimated, and remains more than 3% higher than a year ago, well above anything we saw pre-pandemic. That stickiness, she warns, is amplified by a bifurcated consumer base, what some economists have called the K-shaped economy. This is something that Larry Goldberg and I and Kathy Wood started talking about 2 years ago. Affluent households, maybe even 2.5 years ago. Affluent households continue to spend freely on travel, entertainment, and premium goods, keeping service sector inflation stubborn. Lower and middle income consumers, by contrast, are pushing back, trading down, stretching budgets, or delaying purchases altogether. Retailers are feeling that divide, Swank said, describing a landscape where discount chains are seeing higher income shoppers while subprime delinquencies climb up among those with thinner financial cushions. The result is a headline inflation rate that understates the pain for the median household. People are making tough trade-offs in their baskets of purchases, Swank said. The economy looks better on paper than it feels to the majority of Americans. Swank also believes that part of the gap between reality and perception stems from the government's diminished capacity to collect and verify data. Even before the government shutdown that delayed the CPI release by 9 days, the Bureau of Labor Statistics was operating with roughly 20% fewer staff than before the pandemic, Swank said, and because of the DOGE budget cuts. That means that now more than a third of the price data in the CPI is imputed, estimated rather than directly observed, since fewer agents are collecting prices in person, and their methodologies are absolutely horrible. We're comparing something that's similar in price, but it's not apples to apples, she said. You just can't have as many people in the field taking those samples. That means official inflation readings may be smoother than the real-world volatility consumers experience, particularly for categories where local price savings or shortages matter most, such as the beef prices. For the Fed, the beef prices, of course, which were being impacted by droughts and other issues. For the Fed, that introduces a serious blind spot. Policymakers rely heavily on inflation data to calibrate rate cuts. And if the CPI is built on incomplete sampling, it risks reinforcing the perception that inflation is easing faster than it actually is. I think it's the opposite. I think that the numbers are overstating it, as we will see with TRUflation saying that the number is more in the 2.5 range. These are not completely clean numbers, Swank cautioned. The problem isn't the shutdown, it's the staffing shortages we had going into it. It's the methodologies, Swank. To Swank, the slow breakdown in how we measure the economy itself is almost a bigger story than the monthly inflation. Asked if she was worried that the markets and the U.S. consumer broadly might become more skeptical of the BLS or even accuse the Bureau of politicization, Swank sighed warily. Trust in the data has already been eroding for decades, she said. Now it's accelerating. Well, looking forward, Swank expects the economy to slow dramatically in the fourth quarter, a turn she says was already coming before the shutdown drained 750,000 federal paychecks from the economy. Consumer stress, rising delinquencies, and tariff pass-throughs will all collide with a fragile labor market and a weaker retail season. Absolutely wrong. The fourth quarter is going to be fine. It's already showing that it's going to be fine. All of the people that are reporting on their earnings are giving good guidance. This is not going to be an issue. So she says, we're going into a very difficult holiday season, noting that surveys show consumers want cash more than anything else, a reflection of financial anxiety rather than confidence. The government's tariff waivers may soften some price increases, but she expects uneven effects across sectors. Many tariff-related price pressures are still ahead of us, she said. Now this from TRUflation. Now I've been criticizing this blog that they put out once a month for a very long time because it was definitely slanted left. He was definitely trying to, soften the blow with regard to the Biden administration. But I think maybe they decided it's in their interest not to do this. And this was a very, very balanced blog this month. The U.S. economy expanded at a faster pace than the expected pace in quarter two. We saw that, but that was mostly because of these imbalances. They talk about that. Despite the trade being the headline driver, the trade problem, the trade imbalance, underlying domestic strength remains intact with consumer and business spending remaining strong, while labor market resilience continues to support domestic demand through those signs of weakening are present. Retail sales rose 0.6% month on month and 5% year on year, reflecting solid consumer demand. I've been reporting that to you all along. Business investment continues to accelerate, with equipment investment up 8.5% in August, following a 0.8% gain in July. The strong fundamentals continue to support the positive GDP outlook, with Atlanta Federal Reserve GDP now predicting 3.8% GDP growth in quarter three. The labor market remains resilient, but it's cooling. The initial jobless claims declined by 14,000 to 18,000 the last time that we got the real numbers. But we've seen the numbers since then being put up by Bloomberg and others, and they seem fine. Job growth has slowed in the last 3 months of August, but layoffs remain muted and corporate margins remain solid with little signs of compression, indicating no immediate pressure for widespread cuts. The current conditions does not seem to be a drag on the economy, as more a reflection of policy uncertainty than downturn in demand. TRUflation projects a 3% year-on-year rise in the Bureau of Labor Statistics BLS Consumer Price Index for September. They were right on. Goods inflation is leading the charge as tariffs and depleted inventories are pushing prices higher, continuing a trend through quarter three. Import prices rose again in August, 0.3% though. Like they say, that's the number, with early September data suggesting this trend is set to continue. Energy prices, particularly for fuel and natural gas, contributed to headline inflation this last time. In contrast, core CPI, excluding food and energy, decelerated, driven by weakness in the owned housing components as high mortgage rates continue to weigh on affordability and suppress demand, which I mentioned earlier today will now be reversing, I think maybe certainly by the spring. Services inflation has eased and now trails goods inflation, reflecting the sluggish labor market conditions and slower demand. I think this is temporary. I think this will be picking up again. The services sector as a whole is sluggish. The ISM Services PMI showed stalled growth in September as new orders slowed and employment remained weak. Despite this, input costs and services continue to rise, albeit at a slower rate than goods, underscoring challenges in staffing and wage negotiations. As I mentioned, ISM Manufacturing PMI edged upwards and in a trending towards a recovery, but remained below the 50 level for the seventh consecutive month, signaling continued contraction, but I think that's short-lived. Okay, as noted earlier today in the Monday morning show, we're seeing an increase the last few days in goods inflation, but still only at about 3%, even for the not the highest item. The highest item was in clothing, which was up quite high, around 6%. Up 6% year over year. I'll concede this is likely the tariffs finally hitting, but it will likely fade quickly and represents a small part of the economy. The drop in gasoline and home prices is a huge part of the CPI number, and much of the rest is neutral right now. So I would expect CPI next month to be fine. I'm expecting jobs to continue to be fine. In fact, maybe I'm even seeing a little bit of a hint that jobs might be picking up as we get more and more of this infrastructure being built, as we get more and more companies, manufacturing companies that are having to deal with the onshoring effect. I'm not sure that we won't be a little surprised by what happens in that regard. All right, just for fun, a quick look again. At where we are. Tesla still 438.18. The bonds, when I check, were a little better than an hour ago. Let me see here. There's the bonds up 33.1, so that's down a little bit from where it was. We've got oil sitting just up 11 cents, so that's actually coming down as well. Natural gas up 2%, that's down from where it was. Gold, 38.50, that's up from where it was, so it's pushing back towards 4,100. And silver not as down as it was, only down 0.47% now. Copper up 1.39, a little higher, so a little more higher price for copper. Bitcoin 3,797. I think that's roughly where it was. And the equities, Dow up 0.49, S&P up 0.63, and NASDAQ up 0.82. All of those would be records. To put this all in perspective, if you haven't already listened to it, go back and listen to my earlier show, my regular Monday morning show, where we'll talk about the Fed and all the things that are coming up this week. I'll put that card right up there. And tomorrow, I'm thinking all normal. Larry and Brian White tomorrow. We'll look forward to seeing you then. Don't forget to buy the book. The information is in the description below. It's been great talking to you.